Okay, so you have this great model, and in the horse race analysis that you talked about, we can show that, hey, like renting should come out, the wealth of renters should come out ahead of owners most of the time. And I think that makes a lot of sense for all the reasons we've talked about. The reality, though, is that homeowners tend to be way wealthier. Like in Canada, it's many multiples wealthier. Why? Why? If we can show analytically that renting can come out ahead, why do owners tend to be so much wealthier?
Okay, so again, I would say it's not because of owning a home, it's in spite of owning a home. And really what people and I hear that a lot, right? I mean, so if renting is so great, how all the renters, not all of them, but most of them are, not as wealthy. And the idea is that it's a selection bias. People that are wealthy can afford to buy a home. People that are not wealthy, not have enough down payment, cannot maybe qualify for mortgage, cannot, well, and then they don't. So the idea is that you're not wealthy because you own a home, you almost in many cases in spite of, but also really if you think about it, again, I mentioned before, it is a force mechanism for saving. It makes you disciplined. You buy a home and you're not going to sell it a month from now because your neighbor just sold it for 5% more than you bought it and you think you can also get 5% more. People would do it with a stock or they would panic if it's go the other way around. But with home, you basically have this force mechanism that is not only it appreciates at least in nominal terms over time, you also decrease your debt over time simply by paying off your mortgage. And we're talking about large amount of money. Most people who invest in the stock market, for example, again, I'm talking about the average person. They wouldn't just, so I'm going to just put the initial investment at $350,000. They don't. Most people, okay, I'll invest $5,000 and here's another 500 and here's another 1,500 or so even if the performance there is high, we're talking about a relatively small amount of dollars. If you think about it, there's so many people that have, homes that are worth, 400, 500, 600, $800,000, but the stock portfolio is maybe 50,000, 150. I mean, there are a lot less people that have $800,000 portfolio. All but the very rich, their home is worth significantly more than their stock bond portfolio. So
Now,
it's really a selection bias for the most part.
but I think when people compare how or look at how their wealth grows as a homeowner, I think the number one factor that they believe to be the generator of that wealth is price appreciation in the homes. And I think a lot of people believe that in general, houses go up in value at least as fast as stocks tend to go up in value, maybe more. So, can you talk about how important property appreciation truly is? And if it's not the most important factor here, then what is?
Now, property appreciation is the most important factor in creating wealth when you own. It is, but property appreciation is by far not as fast as return on stocks, and it shouldn't be because really you're getting other benefit from living in a home, right? I mean, it is a place where you live, where you raise your family. So that benefit, I mean, you can think about it as a cash flow because if you would not live in your own home, you'd pay somebody else whatever that home is worth every month. So together, the two should be maybe somewhat comparable to a commercial real estate return between price appreciation and what you would have paid yourself in rent. But price appreciation by itself is not nearly as high as stock appreciation.
Can you talk about
It,
how
it, it
how
can't, sorry, it can't be. It can't be. And let me emphasize it because it's
hmm,
important. We're talking about price appreciation versus inflation. And basically, price appreciation and inflation are very, very, very similar, which means that home prices, on average, do not appreciate in real terms. When I say real terms, I mean adjusted for inflation. Um, and that means that if you have no real price appreciation, but at the same time you have to pay insurance, property taxes, maintenance, you basically, from a financial perspective, in real term, you losing money every year. It's like, well, how does it make sense? Well, yes, it's not that you lose money. it's the cost of living in the home. You're living it out, but this is the benefit that you're getting.
The other piece in there, like if you look at real estate index returns, especially in recent history, they look pretty high. But I was talking to some of the people from Statistics Canada recently, and I figured out how to find I isolate the number of the amount of renovation spending that Canadians do every year from their data, and it's huge. Like as a proportion of the net housing stock in Canada, it's massive. And so you look
Yeah.
at index returns, a meaningful portion of that has come from people spending not just on maintenance and depreciation, but on renovations, like on property improvements.
Yeah.
Anyway,
Yeah, and there are industries that consider that. Again, if you're talking about commercial real estate, they consider that. People will be surprised that, for example, the capex or the expenditure on repair of offices is very high, a little bit less low for retail, even less so on multifamily, very low for industrial storage, etc. But regardless, for the overall universe, is a big number. And again, when people thinking about, okay, I bought this house for 200,000 and I sold it later for 400,000, and let's say it was over a 10-year period, so I doubled my money. It's like, well, you really have to think about it. First of all, you're talking nominal or real. Well, most people don't really understand the difference, but it is a very important distinction. And the other thing is that, what happened in those 10 years? Did you pay insurance? Yes. Did you pay property taxes? Yes. Did you fix this, that? Did you renovate the kitchen? Did you renovate it? The answer to those is, almost all of those is yes. Yet they don't tell you that. They just said, I bought for 200, I sold for 400, so I made 200,000, and they ignore everything that happened in the middle. It's almost like if I invested $10,000 in the stock market, I added $500 every month, and then I would be surprised that I have a lot more, significantly more 10 years later, of course, not only because stocks appreciate, because you continue to add money in. But those are things that homeowners tend to ignore. They know it happened, but nobody would say, I bought it for 200, 400,000 minus the 150 that I spent in discounted and adjusted for risk. People don't calculate it this way, which is okay. They're not academics. They're not, finance is not what they do. But it makes their statement of, I double my money, or this is the best investment ever made, it make it often wrong, or at the very least inaccurate.
Yeah, I think the other piece in there is compounding. Like they'll see what they bought for and what they sold for, but they won't consider the time that has passed. And over a very long period of time, you can get a really big dollar amount, but the compound return is actually really, really small, especially relative to some other investment like stocks.
Yeah.
Okay, can you talk about how important the renter's savings rate is for them to have a comparable wealth outcome to an owner?
Wait, renting save rent. What do you mean?
Like
by that?
the renter is having to save the cost difference between renting and owning.
Yeah. Okay. So this is
they,
that may be going to, well, again, the model is pointing to renters doing better than owners if they do all the right things, meaning that they're investing in, a right combination of stocks and bonds. If they are taking the down payment and investing it in that portfolio, also the additional cost of closing and any differential amounts. In reality, people don't. Okay, the reality is that if you not only that, so you asked before, for example, why renters are less wealthy than homeowners. So one thing is a selection bias, those that can buy. But even more than that, if you know that you need, let's say, to save $60,000 for down payment, you would make a real effort to get there. That by itself move you ahead. So you're going to give up a lot of other things. You save this 60,000. Now you buy a home. It also means that you are a person of different character that were able to put together and save enough 60,000. So you're not tempted by things along the way. So that's another one of those factors that make homeowners better off.
It's interesting that you mentioned that, because I think a real world experiment that you can use to see this tendency. I work with a lot of clients who, were had a year or two left in their mortgage, and they would say to us, as soon as my mortgage is paid off, I'm going to take that $3,000 a month that I was paying to my mortgage, and I'm going to start saving $3,000 a month. And almost nobody does it. And that is a real testament to this idea of forced savings is a lot easier than optional savings. And when you're given the choice between, I mean, you don't have a choice between paying your mortgage and not paying the mortgage, but you do have a choice between saving and spending. And just for most of us, the spending just comes so much easier. So I have very rarely seen people making that transition from forced savings to optional savings. And I think the renter is making that decision every month because there's no forced
So
savings.
so really to answer your question, Ben, for most people, actually the best decision from a monetary perspective is still to own a home, even though if you do the perfect horse race comparison and you do all the right thing, you should be a renter. But owning a home still works for most people because it changes the way they behave in a way that more disciplined investor, for saving, long-term holder, et cetera, et cetera, et cetera. Work in order to get to this down payment, upgrading their home because once you have a home, it's nice, but after a while, it's like, well, but can we get a bigger one? And then you continue that kind of cycle, and that's why most, at least American owners, the majority of the wealth is the equity they have in their home.
Yeah. I do want to come back to that question later because I want to ask about who should rent, even if we agree that most people should buy. I did a YouTube video on this that has not been released yet. It'll come out this Sunday at the time that we're recording. But I say that most people should probably own a home, but then I joke that the nerds watching my YouTube channel about finance are not most people. Anyway, so I'm going to come back to that later. Okay. So we've been talking about rent versus own in fairly general terms, but homes are an asset that can fit into the overall household portfolio. Can you talk about the paper that you did and how you set the model up to compare the risk adjusted wealth accumulation of renter and owner households?
Okay, so we followed up this study with another study that instead of just looking buy versus rent in a vacuum, you're looking at, again, more for real life, because you always take it a step farther of, okay, a home is one of the things that we have in our portfolio. And then you say, well, is buying a home makes sense when it's not the only thing, but it's one additional thing that you have in your portfolio. And the results are basically such that it makes home ownership a little bit more attractive than if it looks at in a vacuum, because it has some hedging characteristics in addition to the other things you have in your portfolio. The problem is that for most people that, I guess, people that don't have a lot of wealth, they have very little of other things beside homes. And then home become too big part of their portfolio. So again, the example of a middle-class family that may own almost by default because the house appreciates so much, they own a $500,000 home, but they really have a stock portfolio of $50,000. And by the way, their net worth is $500,000. They maybe have a mortgage there of $300,000. So the net worth is maybe $250,000, but the home is twice as much as the net worth because the home is worth $500,000. That bring them this I guess over leverage, high volatility, etc. And for those families, owning a home is still less advantageous than renting. Again, from a portfolio perspective, where it makes sense to own a home in a portfolio, from a portfolio perspective, is where owning a home is not, and the down payment to owning that home is not too big part of your overall portfolio. Meaning that, let's say you have a $1 million net worth, and you can put $200,000 into a down payment of a home. The other $800,000 is invested somewhere else. Maybe you take a $300,000 mortgage. For in those cases, homes have hedging characteristics that make it, a good buy. In addition to all the things that we cannot measure.
Yeah, that's really interesting. So someone who's relatively high net worth, buying a home, making the home an asset that's part of their broader portfolio actually looks pretty good on a risk adjusted basis. But if you're overreaching to buy a home and it's your only asset,
Yeah.
you're making yourself worse off.
Yeah. And
Huh.
also overreaching, and it's a problem that a lot of people have. I tell people, you should decide whether you want to take a 30-year mortgage or 15-year mortgage. But I'm telling you, if you cannot afford to take a 15-year mortgage, you probably should not be buying a home. Like, well, but I'm not taking a 15, I'm taking a 30. Well, that's okay. You can still choose to take a 30, but if you cannot take a 15, that means you're stretching yourself too tight. And that means the first thing that is going to come along, whatever it is, major repair, etc., you're not going to be able to handle that. You may be getting into financial distress, and the outcome is typically not favorable.
Yep. Owning a home is like, it kind of sucks. I rented for a very long time. I bought a house 4 years ago now, and it's brutal. It's not fun.
What is it that you don't like about it? Is it just the headaches, the maintenance?
Well, that's what I mean. Like
yeah.
I like the house that we bought, and I like where we live, but you hear a noise and it costs $10,000, and that part's not that fun. Yeah. So it sounds like from what you just said, Ellie, for Dan and I, who tend to work with relatively high net worth investors, in their case, owning a home probably makes sense because it hedges their housing costs and it fits into their overall portfolio.
Yeah.
Yeah, it's interesting.
Yes, it probably does. It also make a lot of sense in places where, if you're really looking at a booming city, and I happen to live in Miami, and really the only way that you can hedge the cost of living effectively is by buying home. So Miami, and I don't know how many of your viewers, probably aware, Miami, the cost of living in Miami increased over time because it became a more and more attractive place to live in the opinion of, I guess, of the consumer. But it really increased significantly during COVID and after COVID. So housing prices doubled and more than doubled in many cases. It became a very expensive place to live. And some people are leaving the town because it's too expensive. Those people that leave town and tell you it's too expensive, those are renters. Those are not people that own a home. People that own a home, they basically locked the biggest item on their the budget, which is home ownership or home cost or mortgage, whatever it is. It's a fixed rate most of the time. The increasing taxes are capped by law here. Yes, insurance is volatile, but still not a huge part of the mortgage. So they're not being forced to leave. The people that be forced to leave are those that used to rent a place for $2,500, but now it's $6,000, and it really happened over a 3 or 4 year period. If you cannot afford these $6,000 instead of $25,000, and most people can't, you have to find a solution. So, buying a home make a lot of sense for those areas where you have limited amount of land, and there is something happening in the city or in the area that may make it prohibitively unaffordable. And Miami is one of those places. So again, people here, they ask me, should I buy or rent? And I tell them, again, here's the analysis, what happened on average, etc. But really, if you really want to protect yourself and you want to stay living in Miami for a while, you probably should buy. And that is one thing. And then if you want to hedge all the rest of the cost of living, again, Miami or any other place, then you should buy yourself a rental property. That again, you hedge your own cost of living by buying your own home. And then as the city getting more expensive, if you own a rental property, whether it is a fourplex or kind of townhomes, whatever it is, the rent that you receive is now a lot higher, allow you to do the other things that the city is asking more for. And those tend to be highly correlated.
Huh. So that's really interesting.
Yeah. So it's not like, grocery costs are going up and private schooling costs is going up, and then rent doesn't. It typically go hand in hand. So I'm not saying 1-to-1, but it's probably the closest hedge you can get. If you own a rental property and you own your own home in the area where you live, it is extremely unlikely you're going to be kicked out of that city because it become unaffordable to you.
Yeah. I think that's my favorite argument for owning. I completely agree. I think the thing that I'm always careful to say, though, is that a hedge can cut both ways. If living costs are going up in a city, great. But I look at Toronto, and in March 2022, it was $1.3 million for a composite index to buy a home. And as of March 2025, it's just over $1 million. And so it's like, it's great if living costs are going up, if housing costs are going up, but you have to be really certain you're going to stay there for a long time, because the person that bought in Toronto in 2022 and decided to leave now.
And that's the thing, if you decide to leave from Toronto to a different place, I understand. But also, if they decide to leave, I'm assuming they're going to be moving to another city in Canada, most likely, where probably the price, it's unlikely, even though it's possible, it also went down. So they are selling for 20% less, but also buying something else for 20% less. And those that are not selling, you have to think about it. And again, we have a lot of discussion about that. Your house went up from $1 million to $800,000. But guess what? Your house is still a 3-bedroom, 2-bath house. It's still in the same neighborhood with the same amenities, in the same school. You didn't really decrease your lifestyle because of that. It is different if your portfolio is going down, or if your income is coming down, or if something that any kind of benefit you receive changed. But in this case, the amenities you receive from that home is the exact same amenities, the same size, it's the same neighborhood, it's the same benefit you receive every month. It just less. And even more so on the upside. If you really think about it, people that feel richer because they have a property that they bought for $500,000, now it's $1 million. They have more net worth, but the lifestyle did not change. They still live in the same place, same neighborhood, same size apartment, etc., etc., etc. The only thing that changed for them is that it becomes more difficult for them to upgrade their home, because now prices double. So their property went from $500,000 to $1 million. Let's say that historically they can add $100,000 or $200,000 and get a significantly better home that they wanted at some time but couldn't afford it. Now it's not $100,000 to $200,000 more. Now it's $400,000 or $600,000 more. Okay, it makes more difficult to make it to the next level. So yes, it's going both ways, but it's clearly a hedge, and you really have to think about your housing wealth and how much wealth you generate by increase or decrease in the value of your homes does not really change your quality of life. To me, somebody who's wealthier is somebody who can afford a higher quality of life. If you just have more dollars to your net worth, but your lifestyle is the same, then depends on what definition you use, but I would say you're not wealthier.
Yeah, interesting. How efficient? So we've been talking about how real estate prices change, and a lot of it sounded like a discount rate story. But anyway, how efficient do you think the real estate market is relative to the stock market?
The real estate market is a lot less efficient than the stock market. There's no doubt about it. There's a lot of evidence that I can predict where housing prices will be higher than I can predict if city A versus city B with pretty high probability. I can predict that city A is going to appreciate faster than city B. You cannot predict with any high probability, basically 50-50. If I give you two stocks, which stock is going to do better next year? Stock X or stock Y? You can guess, but you're going to be 50-50 in most cases. On housing, I can probably do that with a 80-20 probability, simply based on momentum and a few other factors. So there's a lot of evidence of the housing market is a lot less efficient than the stock market. It's just more predictable.
What do you think causes it to be less efficient?
Well, one of the main things that make it less efficient is the fact that most transactions are being done by non-professionals. So think about it. Who own home? It's just the average person that own home. They're a nurse, they're a doctor, they're an engineer, they are a scientist, they are a teacher, whatever it is. They're not a real estate professional. These are the people that buy and sell homes. They're the one deciding the prices of homes just by buying and selling them. That is very different than the stock market, where the majority, on the margin, the price of every stock is being decided by professionals that run a cash flow analysis, and they predict what's going to be the earning of this company versus the other company in the future, etc. And then they're pricing it every single second of the day. So just that pure distinction between price determined by professionals, that this is what they do, versus price being determined by just the average homeowner, make the stock market a lot more efficient. In addition to that, and I can give you 20 factors, but we don't have time. But I think another big one is the emotional factor that's going into buying a home. So, I don't know if you're married, but if you are, it doesn't. You can describe to your wife, for example, and I'm half joking, but this house is a better deal than this house. It's just a better value, and you can maybe put an Excel spreadsheet and you can show her that you get more money per square foot, and you can all this is nice and good, except if your spouse feels better in the house that is maybe not as good of a value, then it doesn't matter. People buy a home based on how they are. It's an emotional connection. It's an emotional decision. Of course, financial too, but to a large extent, emotional. And sometimes they would pay more or less for a home just because how they feel about it, not necessarily because it's a good value or less value. I tell my students a lot of time, you can relatively easy find deals on what I call a piece of property. That's an investment property. And in the past, I bought properties sight unseen. I know the area. I know that you send the broker, whatever. You can buy it based on the cash flows. But on a home, it's a lot more difficult to get a great deal. Something that is all of a sudden really cheap and you happen to love it, more difficult, a lot more difficult. So the emotional part and the fact that it is professional versus non-professional determining prices. Those are probably the biggest two factors.
Can you give us some examples of those emotional or psychological biases, like specific ones? And I'm wondering whether, when people are selling their homes, I think there's a tendency to exploit some of those psychological and emotional biases in order to get a higher price. Is that something you can think of examples of?
I don't think they're trying to exploit those, but there's definitely a bias of, my home is the best because look how beautiful it is. And I know that the neighbors sold their house for 450, but ours, of course, is a lot nicer, right? There's always this, and really to them it is nicer because they have maybe memories there, they have connection. It's their choice of whatever, the carpet, the wood, the kitchen. To them, it's the best. And many times, I think the job of a good real estate agent is to kind of bring them down. It's like, well, I know you love the home, and you have emotional connection, and maybe you raised 3 kids here, and you have a lot of good memories, etc. But at the end of the day, this kitchen is dated, and this a carpet, it's your choice, and that's fine. But whoever is going to buy it is going to probably, completely replace it. So those are actually the kind of things that need to be worked out during transaction, and that's why it's an emotional decision, not just for the buyer and for the seller. I don't know if that was specific enough, but that is definitely a factor that need to be considered.
Sounds like the endowment bias. People value it more just because they own it already.
Yeah.
And maybe familiarity bias too. I don't know. Okay. So you've said, and Dan and I have said this on this podcast too, most people should probably own a home, as opposed to renting for all of the behavioral and hedging reasons that we've talked about. What are the main, but we've also established that renting can come out ahead. We can show in a model that renting should come out ahead more often than not. What are the main decision points that would push you or lead you to push someone else one way or the other between renting and owning?
I think, well, we talked about why you should be buying, and there's a lot of reasons for that. On the rent side, I think the people that, again, for them, it's a big stretch to buy a home, meaning they need to take too big of a mortgage. The mortgage payment will be too big part of their monthly income. They may not be able to afford repair or things like that. That's number one. And then I think probably almost as important is that, especially for young people, young professionals, that those people that are young professionals, they would move around a lot more often than they think they will. So as you're becoming more valuable in the market, it is likely you're going to be moving out, from one position to the next. How many times there's a person that just bought a home and they got a promotion, but they need to move from whatever Atlanta to Chicago, and they wouldn't take this promotion because they just bought a home. Except that, if they're rent, they can just cancel the lease. Maybe they pay a small penalty, or maybe even their employer will pay that for them. 2 months of rent typically. They would take the promotion, will make more money. It will move them ahead for whatever the next position after that, etc. People underestimate how often you move when you are young, and this is especially true for large countries where every move is make it impossible to stay in the old location. So if you think about the United States, right? I mean, if you move from Atlanta to Chicago, you have to move. You can't just commute. Even in South Florida, if you moving from, you got a position from Miami and now you got a position in Boca with traffic and all that, no, you have to move again. In those cases, if you move a lot, or if you expect to move a lot, even if you don't know it, probably renting make a lot of sense in large countries like the US. I'm originally from Israel. That problem is not there. So Israel is a very small place. And typically, again, you buy your home and the home ownership is very high. And if you move around, then you drive, instead of 30 minutes this direction, you just drive 30 minutes the other direction. It's not like you're going to be moving 4 hours away. There's no 4 hours away almost. So yes, you're moving one company to the next, or you get promotion, etc. But you can still keep living in the same place. This is not how it is in the United States. So transaction costs in terms of moving, living, and giving up an opportunity because you own a home is very costly. Again, something the model does not consider, but should be considered.